We now prepare to embark on a journey of resilience with our speaker session titled Building Resilience, Navigating Fintech Through Cycles. Join us as we delve into the essential strategies and practices for fintech firms to withstand the ebb and flow of economic cycles. Discover how successful fintech enterprises adapt and thrive in the face of market volatility and uncertainty. Gain invaluable insights into risk mitigation techniques, adaptive business models, and effective crisis management approaches with Shashank Rishikstringa, co-founder, Axio. Let's have him on stage, please.
Thank you very much. Am I audible? Yeah, great. Great to see you all today, and thanks to the organizers for having me for this session. I think it's an interesting topic, volatility. And I think we can all agree that we live in a time of volatility in the world, if I can make such a bold statement, but definitely in fintech. I was at a friend's place for dinner the other day, and I introduced myself to someone as a fintech entrepreneur. And immediately the questions came: what's happening with unsecured lending? What's happening with RBI? What's happening with Paytm? Now, on the positive side, 5 years ago, I had to explain what fintech was. On the flip side, I think it's a small example of how volatility is permeated through all aspects of the sector today. Our first experience of volatility at Axio was in 2019. We had had 4 years of smooth sailing. We had just closed a large debt transaction that was going to fund the next year of growth. I remember my team got on a plane to fly to Chennai to literally sign the paperwork. While they were in the air, ILFS collapsed, and when they landed, the deal was off the table. A year later, COVID happened. And ever since then, over the last 5 years, I think for this sector as a whole, there have been regular reminders that we operate in an uncertain, volatile environment. And in 2019, when this first happened to us, it felt like a shock. We reacted, we scrambled, we tried a bunch of things. The next time around, there were the beginnings of the playbook. And by moment 3, 4, 5, 6, it started to feel like business as usual. And one of the ideas that we've been thinking through deeply at Axio is, how do you think about volatility when building a fintech company or a lending company? Because the reality is, it shouldn't come as a surprise. Finance as a space is inherently volatile. Right? It invented the term volatility, and that volatility comes from leverage. Leverage amplifies returns, it also amplifies losses. Tech, as a sector, is also volatile, but for different reasons. Here, you have obsolescence, you have product hype cycles, you have a series of experiments and failures that ultimately lead to success. You put the two together, and you have fintech, a very exciting space, but also one where I would contend volatilities don't add, they multiply. And if you buy this, what does it mean to operate in a sector that is volatility squared? First, it means that returns are also squared, right? We all, as finance professionals, live in this framework of risk-adjusted return. And I think it's no surprise today that with all the turmoil in the startup environment, fintech companies, especially digital lending companies, are growing the fastest and delivering the most profits. So there's a big prize for handling this level of risk and this level of volatility. But what it also means is that volatility may not be something that happens to us. It may not be an aberration. It may not be a one-off. It might actually be a structural part of building in fintech? And that starts to become a very compelling question, right? Because if it is a structural part of this sector, how do we go beyond coping with volatility, beyond managing volatility, beyond being resilient, to actually embracing volatility as a part of how we do business? And a concept that I have found particularly useful in this regard is this idea of anti-fragility. For those of you who've read the book by Nassim Nicholas Taleb, author of Black Swan, Fooled by Randomness, this book in many ways is the culmination of his work around randomness, around shocks. And he contends that anti-fragility is beyond resilience or robustness. The resilient resists shocks and stays the same. The anti-fragile gets better. And what this means, as per his thesis, is that anti-fragility is the property of systems in which they increase in their capability to thrive as a result of stressors, shocks, volatility, noise, mistakes, faults, attacks, or failures. It's a very exciting idea. How do you build an anti-fragile fintech company that can take all of this volatility and turn it into something more powerful, more long-lasting, more enduring? It's also a tough question to answer. And over the last few years, this has been a work in progress for us. And by no means will I say we are anti-fragile, but we hope to be on that path. And what I thought to do today is share a couple of our learnings in that journey. And these learnings really center around two ideas. The first is that there is a set of tools or a toolkit to build resilience and manage through volatility. And the second is there is a mindset in an organization that can lead it to becoming resilient or anti-fragile. So let's start with the tools, right? What are the ingredients that we have learned so far? It's, again, one person's view, by no means comprehensive. So take from it what you will. The first part of this toolkit is cash flow management. Now, this sounds very simple. As my business school professor used to say, cash flow is more important than your mother. I would agree with him. But the reality is very few startups below the age of 5 spend a lot of time on cash flow management. And the first time we hit volatility in 2019, this is what saved us. Starting to monitor cash flow on a day-to-day granular basis, build a rolling 10-week forecast, and embed cash flow discipline and management within the team. And it starts with measurement, but ultimately it actually comes down to how you think about growth. Because growth is one of those things, in lending in particular, that can generate cash, but it can also use up cash. And in a volatile macro, the last thing you want to be is in a situation where you're actually using up more cash than you generate. And so one of the key areas of learnings for us here was how to identify those levers of growth that help you slow down intelligently in places where you can generate more cash without being out of pocket on cash for lending, right? And this is, as you will appreciate, harder than it sounds, because in startups, in tech, we're all about growth. Slowing down growth feels like the opposite, but in some cases, slowing down growth is the right choice. But it's how you slow it down that's critical, right? Selecting the highest risk segments to slow down. Knowing in good times what areas of your P&L, your product, your customers, you will reduce when you hit a macro. And so turning cash flow management into not just a wartime skill, but a peacetime skill for the team is something that we found to be hugely important. The second is around the liquidity stack. Again, a learning for us. It's extremely tempting when things are good to double down on whatever area of liquidity is working for you and just keep going. Liquidity diversification is hard work. But again, what we found through the last 5 years of turbulence in this area is that each crisis, each moment of dislocation forced us to unlock a new lever in this liquidity stack. from bank debt to NBFC debt, family offices, direct assignment, securitization, co-lending, you name it. And once this stack was fully built, we had the ability to flex the right levers to ensure that we could keep liquidity, ALM going to meet the cash flow and growth requirements of this business. And the reality is, all levers of liquidity don't dry up at once. And so having this stack in its entirety and knowing which levers are likely to work in which environment can be a crucial part of the toolkit to ensuring that in times of challenge, you're not just staying afloat, but you're growing. Third, cost optimization. There's a lot of talk about cost right now. I find inevitably when funding is tight, people talk about cost. Again, our learning, cost optimization is a skill that needs to be always on. Because it's not just about making cuts. It's about re-engineering your cost base so you can flex it up and down seamlessly when the environment demands. It's variabilizing as much of your cost base as possible. It's making those buy versus build decisions so that in moments of stress, flexing your cost base down is not difficult. It doesn't damage company morale. It's just part of doing business. And this also means having a team that is always working on cost, both in good times and in bad times. Before the last, infrastructure flexibility. We rarely talk about infrastructure in fintech, right? It's one of those things that happen in the back office. But our financial system today is so interconnected, and the infrastructure that we sit on is even more interconnected, whether it's KYC, payments, right? Setting up standing instructions, compliance, collections, all of the above. And what we've seen over the last few years is volatility strikes not just in credit, but in infrastructure as well. Certain KYC modes change under regulatory pressure. Certain parts of the payment networks fail at times. And so how do you build an infrastructure stack that is flexible and has enough optionality so that when one thing goes down, you can switch on others? And a big part of infrastructure is actually collections. That is the backbone of a lending business, digital or physical. And how to create a collections capability that can also be flexed up and flexed down, preemptively in some cases if there is a credit cycle coming, is a core part of how we think about infrastructure. Last but not least, sounds like motherhood and apple pie, but forecasting. Right? It took us years to actually get good at this, actually being able to say that I understand my business to such an extent that I can forecast that in this state of the world versus that state of the world, this business will deliver so much revenue and so much profit, right? I think Eisenhower once said, right, plans are nothing, planning is everything. And the ability to react rapidly to changing states of the world, the ability to imagine what your business will look like in 5 different states of the world before they happen and make informed decisions accurately is entirely down to the ability to have high fidelity forecasting. And today, if I look internally at our organization, the team that I spend the most time on is not product, it's not tech, it's not risk, it's actually our FP&A team. Because this team becomes the backbone of any organization that's looking to build resilience and the ability to navigate cycles. So, I talked a lot about the toolkit. And some of this may sound mundane, boring, technical, but the reality is finance is a detail-oriented business, right? And fintech just makes it more complex. So these tools we found to be critical, not just as tools that you build when things are tough, but tools that you embed in the DNA of your organization through good times and bad times, through up times and down times. And when these tools become part of how an organization operates, then cycles are just different modes of operating. At the same time, these are tools. Fintech is a human capital business, right? It's people making decisions, it's people building tech, it's people building algorithms. So as important as tools is mindset. And there's been a lot of literature in the startup world in particular about peacetime and wartime, and how you have peacetime CEOs and wartime CEOs, peacetime team members, wartime team members, right? Peacetime is associated with predictability, long-range planning, steadiness, work-life balance. Wartime is associated with agility, iteration, ability to chuck plans and make new ones, and being always on. And the truth is, Fintech is a big part of wartime business, right? Cycles are a part of life. Volatility is a part of life. And so having this ability to toggle between peacetime and wartime without it psychologically affecting the team, without it getting people down, is critical. And what we found over the years is when you treat wartime not as an isolated incident, but actually something that keeps coming back, you start to see changes in the team as well. We literally have members in our team today who get bored during peacetime and come alive during wartime. You can see them literally energized when there is something untoward to deal with or a black swan to deal with. But I will leave you today with a thought that challenges this idea that there is peacetime and there is wartime. Because I truly believe that Fintech is a sector where there is always peacetime and always wartime. And a strong organization, an anti-fragile organization, has the ability to keep both these ideas in its head at the same time. And I think one of the key areas that makes this toggling possible is this idea of managing polarities. Right? Now, what are polarities? Polarities, there's a lot of literature about it. I could spend an hour here, but polarities are typically ideas that people generally think are competing with each other, right? Growth versus risk, experimentation versus profitability, customer experience versus compliance, structure versus flexibility, centralization versus decentralization. And what generally happens in organizations is you see a lot of oscillation between these two modes. You see a lot of fighting between these two extremes, right? We like to say that organizations in lending that are focused on growth lose sight of risk. Organizations that only think about risk can't grow. Traditional institutions are so focused on compliance that they can't innovate on customer experience. Fintechs, like literally at the cost of compliance, innovate on customer journeys. I think my challenge to you, and I think we challenge ourselves internally today, is to change these from kind of or ideas to and ideas, right? How do you build an organizational DNA that can focus on growth and risk at the same time? Focus on customer experience and compliance at the same time. Now, I'm sure you're thinking, that sounds like a very nice idea. How do you actually do it? And again, I leave you with a couple of thoughts here, right, that really center around organizational design. One of the things that we found very powerful is to embed these polarities into teams right to the most junior level. For example, putting a CX designer alongside a compliance officer to design a customer journey. Putting a product manager alongside a risk manager to actually come up with a sales plan for a product. Right? This is not easy. There are tears, there are fights. Very often, this breaks down at multiple levels across the org. But what this creative tension does is it ensures that at the ground level, the organization is finding ways to create and solutions that take into account both these priorities, not just at a senior level, right? The other way where we have found success here is in how you design the metrics, right? This idea of you are what you get, what you measure. And particularly powerful in that has been this concept of guardrails. Can you create growth targets with the right risk guardrails? Can you create customer experience metrics that have a compliance guardrails? And what this means essentially is giving teams in the organization, business lines, business owners, the ability to optimize for a certain outcome while defining the box in which they can play to ensure that at no point do they lose their way and get stuck in any of these two extremes. And what that does, I think, in our experience and also in our hope over time is go from being an organization that yo-yos, right? Starts with growth, then goes all about risk, then comes all back to growth and keeps going up and down like this, to an organization that is able to at any point in time hold these two competing ideas in its head at the same time. As I said, not easy, but if design of a team, design of a company, design of performance measurement, scorecards, appraisal cycles, take into account the need to balance these polarities, then you start to see a very different kind of organization emerges, where product managers today are more worried about risk than credit managers, which I think is actually a great place to be. Finally, if volatility is a part of life, the simplest way to play volatility is to take a long view, right? We always hear this idea that over time the stock market always delivers returns if you don't exit in the short run. And I think businesses in fintech are very similar. A long-term view, a long-term perspective towards risk, towards compliance, towards growth, makes the organization far more capable of being able to actually manage through these cycles, which are a part of life. So, playing the long game, right, I think is a credo that we've tried to embrace and push all up and down through the team, but I also think it's critical to managing in a volatility squared environment. And last, at the risk of being cheesy, in fintech, it's not peacetime, it's not wartime, it's always game time. This is our business, and the returns more than make up for it. Thank you.
Thank you, Shashank. That was an interesting session on how to manage volatile environments just by being anti-fragile.